The export-driven New Zealand economy relies heavily on the global financial situation. So, with uncertainty high, it came as little surprise that the Reserve Bank of New Zealand chose to keep rates on hold on Thursday following the cut in March after the Christchurch earthquake. When the country will see a rate hike is not as clear-cut, with disagreement on the strength of the economy and the impact of inflation and the Kiwi dollar. I'm joined on the line now to discuss this by two of New Zealand's leading economists. First, let me turn to the Chief Economist of ASB Bank in New Zealand, who is speaking to Dukascopy TV from Wellington, where he attended the RBNZ meeting. Nick, no surprise the rates were kept on hold, but what will be the factor behind any future rate rise, and when do you think that could come?
The real thing that has been influencing the rate outlook for New Zealand over the last month has been what's happening offshore. Prior to the market panic that we saw in August and the clear deterioration in a number of Western economies, the Reserve Bank looked very ready to actually lift rates at this particular meeting. So we had seen rates get dropped back in March after the earthquakes that hit in February as an insurance measure, and that has clearly become unneeded with the domestic economy actually doing very well. Realistically, we may see the Reserve Bank wait until March. So I think a rate increase at the next meeting, late October, is very unlikely. December rate increases is possible, but it really does require that European situation in particular to be settling down, and none of us really know for sure when that's going to happen, but that seems like that's a little bit too soon. So it does look like it's the early parts of next year, but it really is fluid on that environment. But our view at the moment is March is when we're likely to see rates going back up.
Let's turn to the New Zealand dollar now, because the Kiwi hit a 30-year peak against the buck last month. What impact is the appreciation of the currency having on the economy and those all-important exports?
The New Zealand dollar is certainly one issue that is constraining the pace of recovery, but it is a bit of a mixed bag. I mean, part of the reason why the currency is so high will be related to the reasonable strength that we have in our export commodity prices. So we're still very reliant on dairy, meat, wool exports, and the prices for all of those in global markets have been very firm. So that, despite the high exchange rate, we've actually had a very strong performance out of those rural exports. We actually have a very low exchange rate at the moment against Australia, and that is still New Zealand's largest trading partner, taking about a quarter of New Zealand's exports, and particularly those for manufactured exports where there isn't so much of that pricing power that we have in the commodity market. So we have found that about 2/3 of our export basket has been shielded fairly well from the high currency. But yes, exporters who are focused on the US, the European and the UK markets have certainly found life more challenging, and the tourism industry, particularly with tourists from those areas, has been relatively weak over the last couple of years.
Finally, Nick, a report this week suggested the Rugby World Cup in the country could boost the economy by as much as $1.2 billion. Do you buy into that? And when is the country likely to see the benefits?
I think the way to look at the impact of the Rugby World Cup, yes, it's a nice fillip, particularly for the hospitality area and the retail area and that tourism-related area, but it's a short-term thing. So we wouldn't read too much into the overall impact. It will help give a little bit of a shot in the arm, and it is going to have some sort of impact on, I think, general confidence, positively or negatively, depending on how the result goes.
Joining me now is Shamabil Ekub, who is Principal Economist for the New Zealand Institute of Economic Research. Shamabil, the NZIER have called for rates not to rise till at least June next year. Why are you on the more bearish side of economists on this?
Well, I always like to be bearish, mainly because we're seeing some pretty big changes happening, both in New Zealand but also globally. In New Zealand, we have a massive amount of deleveraging taking place across the household sector, across the government sector and farms. And we think the recovery in the economy is going to be quite shallow. And not only that, we're also coming off the back of major earthquakes in Christchurch, which is our second largest city. And the disruptions from that will take a long time. And what we think we will see is an economy that's still quite fragile, still very vulnerable to the global shocks that we're seeing amongst this already quite slow recovery in the domestic economy.
What could force the hand of the RBNZ, of course, is inflation. It has risen this year with the economy beginning to rebound and building work beginning after the earthquake. Do you think that means we could see a rate rise sooner?
Look, the inflation picture has actually been quite, impacted by what has happened in terms of the introduction of a higher GST rate, a whole bunch of administrative charges that have come through. But in the more contestable parts of the economy, there is in fact deflation right now. So for most of the discretionary parts of the economy where the Reserve Bank would have some impact, is already doing it pretty tough. They're cutting prices to attract consumers. And what we're seeing is the higher prices in things like food, fuel, rates, insurance, that's actually acting as a tax on other spending. So we're still not seeing the increases in headline inflation really coming through to more generalized inflation, coming through to wage demands, or in fact becoming embedded in any real way. So I'm really not concerned about inflation yet. I think we will have to see a much stronger recovery, some real tensions coming through, capacity shortages in Christchurch, and we're not seeing those yet. The Canterbury rebuild hasn't even really started yet, and we don't think that's going to ramp up until well into sometime next year.
Finally, on the earthquake, the rate cut in March was called an insurance cut after the disaster. Do you think the hold is more due to the continuing ramifications of the earthquake or now more global factors?
Well, I think firstly the label that it was insurance cut was invented by the Reserve Bank and inaccurate. They were really unwinding a rate hike they had delivered a year before that was a mistake. So this was really unwinding a mistake in the first place. But what we're seeing at the moment is really a global concern that's keeping interest rates low for now. We think that the Reserve Bank would like to raise interest rates. The Reserve Bank is certainly on the hawkish side of central banks. But with global markets being as unsettled as they are, and given that New Zealand banks are very reliant on overseas funding, it is definitely the global situation that is holding them back from raising interest rates.
That is all we have time for. Thank you to both of my guests. There'll be more to keep you updated on news that could move the currency markets this week, including a Targets in Focus with National Australia Bank, so stay tuned.